For decades, our money stopped moving on bank holidays. But in 2026, that system is quietly disappearing. Welcome to Jenny Insights Money and Mind. Today we'll explore the new reality of continuous cash flow. While the traditional banks across Europe closed their doors this weekend, $50 billion in global value was settled in under 3 minutes using financial rails that do not recognize Sundays or bank holidays. At the World Economic Forum in Davos, Mark Carney just delivered a blunt warning that marks the start of a revolution. Lazy deposits, cash sitting in 0% checking accounts, are no longer just a personal oversight. They are a measurable constraint on national growth. We have officially moved past the era where money is a static instrument. In 2026, liquidity is high-velocity software. As global stablecoin transaction volumes surpass the combined capacity of Visa and MasterCard, processing a staggering $18 trillion annually, the gap between those who save and those who navigate capital has become a chasm. Today, we are auditing the 2026 cash flow revolution. We'll reveal the Carney doctrine for your personal treasury, the invisible repo market signal that says your safe cash is currently your biggest liability, and the exact multi-layer playbook to turn stagnant savings into a 24/7 stability engine. If you're waiting for Monday morning to move your money, you've already lost the trade. Let's look at the numbers. We call this the first pillar because technology forms the foundation upon which every financial decision in 2026 is built. You can't improve your cash flow if you're still using 20th century tools. Mark Carney's recent address at Davos signaled a historic turning point: the shift from AI assistance, where a bot merely helps you write an email, to what he terms transactional authority. Put simply, we are entering the era of money that thinks. Your bank is no longer just a digital vault. It is becoming a semi-autonomous agent with the authority to act on your behalf. To see where this is going, look at the major players who are already implementing the 2026 strategy. Goldman Sachs is currently deploying autonomous agents powered by the latest Claude models to handle process-intensive functions such as client onboarding and complex trade reconciliation. These aren't just chatbots. They are digital coworkers that coordinate across different software tools to execute business outcomes without you having to click approve at every step. Meanwhile, Lloyds Banking Group has announced that its enterprise-wide deployment of Agentic AI will generate over £100 million in value this year alone by automating thousands of routine fraud investigations and complex complaints. This represents a definitive shift from digitized banking, which was simply old legacy systems with a mobile app overlay, to truly digital banking, which reimagines money movement from the ground up. In AI economics, we're seeing a new 70-20-10 rule emerge. 70% of all spending is now flowing into the compute and infrastructure layers, the GPUs and data centers that power these agents, while only 10% remains for simple software apps. This is why infrastructure is the new oil of the 2026 reset. These tools are game changers, even for small businesses. We have seen N8N-based agents being used to monitor shipment APs and automatically reroute logistics, saving medium-sized firms up to $25,000 a month in penalties. Furthermore, 9 major European banks are collaborating on a MiCA-compliant, euro-denominated digital offering designed specifically for 24/7 instant settlement rails. The data is undeniable. Stablecoins have now achieved an annual monetary velocity of 110x. This means the average digital dollar circulates once every 3.3 days, whereas traditional Eurozone bank deposits move once per quarter at best. By 2026, firms that treat liquidity as a product feature rather than an expense will have a significant competitive advantage. By utilizing these financial rails, which are always available, you can replace the friction of bank holiday pauses with instant settlement finality. You can maintain your $2,000 sanity shield in a high-yield account, while ensuring that every other euro earns a 3.2% yield in price-sensitive bond markets 24 hours a day, 7 days a week. This replaces delayed balance snapshots with real-time insights, thereby strengthening your internal controls and improving your forecasting accuracy. If your financial institution still makes you wait 48 hours for a cross-border transfer, you are effectively paying the uncertainty tax in its most expensive form. lost opportunity cost in a high-velocity market where speed and stability are mandatory requirements. While the technology of money is accelerating, the plumbing of the system is failing. We are currently witnessing 8 months of global stimulus unravel in record time. Repo market spikes sudden. Violent jumps in the cost for banks to borrow from each other are sending a distress signal from the deepest part of the financial system. History tells us that repo spikes always come first. The systemic consequences come later. To keep the plumbing from freezing, the Federal Reserve has been forced into $12.5 billion daily injections. For the European investor, this creates what analysts call a structural mismatch. European governments are set to issue a record high €930 billion in net government bonds this year, with gross issuance near €1.4 trillion. But the anchor investors, the domestic pension funds that guaranteed a bid for decades, are leaving the building. The Dutch pension overhaul alone has triggered a structural decline in bond demand estimated at €100 billion. This has created a massive liquidity vacuum. When reliable captive buyers disappear, the entire financial system must reprice itself to attract new, price-sensitive buyers, and that includes you. This is why mortgage rates of 3.35% have become the new normal in Europe, regardless of what the ECB says in their press conferences. If you have excessive liquidity sitting in a single currency or a single institution, you are carrying a counterparty risk that Ray Dalio warns is a hallmark of Stage 5 empire decline. Your emergency fund must evolve from a single bank account into a multi-layered fortress of non-printable assets and inflation-protected securities. In a Stage 5 transition, soft landing is a hope, but a financial heart attack is the risk you must insure against. We are entering a phase where structural imbalances, not policy choices, will decide the next big move in the markets. How do you build a stability engine as an individual when the macro environment is so volatile? Former investment banker Nisha Shah recently went viral for auditing her own business to show the real deal on cash flow in 2026. The secret is unstarting a high-gloss side hustle. It's turning your primary income into a stability engine. The data shows that 36% of adults now earn extra income through gig work, but the winners are those focusing on temporal mismatch management. This is the risk of having your money tied up when you actually need it. If you need money in the next few years and you're allocating funds to private, illiquid instruments, you are taking a risk that 2026 markets will punish. Nisha's blueprint for 202 is your roadmap. 1. The 9-month rule. For freelancers and those in a cooling labor market, a 9-month buffer is the new prerequisite for taking any risk. 2. FU Step 4 to Step 7. You must crush chainsaw dangerous, high-interest debt, which is hitting record levels across the UK and Europe, before you even look for returns. 3. The high-skill pivot. Focus on side hustles with proven manufacturing modes. High-skill roles like digital entrepreneurship and motion graphics are paying up to $53 per hour, providing the margin needed to fund your army of dollar bills. For European families, the 15.4% savings rate is often a fear-hoarding trap. You cannot save your way to $1 million in a 2.2% core inflation environment. We close with the ultimate warning. Ray Dalio argues that the global order is no longer just stressed. It is teetering into Stage 6, the war stage. This is defined by internal divisions where the top 1% hold 32% of assets, leading to a collapse of political compromise. With interest payments on global debt hitting $1 trillion annually, they act like plaque in the arteries of the economy, crowding out all productive growth. Dalio identifies 3 pillars of peril, converging in 2026, a policy-induced recession driven by a tariff time bomb, an erosion of foreign confidence in US and Euro assets, and the escalating arms race. In this environment, your liquidity fund needs a military-industrial mindset. Conflict drives demand, and defense and infrastructure stocks are currently outpacing the S&P 500 as the global order splinters into competing blocks. The new all-weather playbook for the Stage 6 transition requires 1. A 15% strategic buffer. Dalio recommends that gold, a tangible asset with no counterparty risk, should make up 15% of your mix as a hedge against currency debasement. 2. Regional resilience. Move beyond global efficiency and focus on localized security. Real assets like energy networks and water stewardship are the only reliable ballasts when the monetary order breaks down. 3. Right-sizing risk. If confidence cracks in a nation's debt, the repricing will be brutal and rapid. Stop paying the €200 uncertainty tax, and instead build a portfolio of resilience that survives a grinding, multi-year deterioration of the system. Have you heard about the 2026 cash flow revolution? It's a huge lesson for all of us. Major technical shifts like changes in stablecoin velocity or the big Dutch pension overhaul aren't just news headlines. They have real consequences that ripple out and hit your bank account every single day. We're past the era where you could win just by owning assets. Now the real winners are those who know how to navigate these complex changes. It's all about securing your foundations today. If you want to see the specific 2026 bond ETFs and high-velocity tools we were using to lock in these 3.2% yields before the next central bank move, you need to tune in. This Wednesday, March 11th, we're redoing a full technical breakdown of the refinancing wave that almost no one is talking about. Thanks for watching, and remember, in a world of 24/7 liquidity, your only real risk is standing still. I'll see you in the next one.